Hello, everyone. Welcome to video 3 of chapter 10. We've talked a lot about the contribution space, but I want to have a bit more chance to do those calculations, but also address how do we handle the contribution deduction. So the main benefit of the RSP is the ability to deduct from income. The contribution space says how much I can put into the account, but I don't have to take that deduction from income right away. So if I put $10,000 into my RSP, I want to deduct $10,000 from my income. That's what gets me the tax savings this year. So if my tax rate is 26%, I deduct $10,000, I'm going to save $2,600, right? Right now. And then I'll pay those taxes when I withdraw. But let's say I've been working on a big project at work and it's going to complete next year. And my boss has all but said, hey, when that project's finished, there's going to be a big bonus coming your way. So now I know I'm going to have this cash influx next year. So right now, my tax rate's 26%, but after my bonus, it's going to be 33. So if I deduct that $10,000 now, I'll save 2,600. But if I hang on to it for a year, I'll save 3,300. So it's best used in times when I have a higher tax bracket. So there's no requirement that contributions be deducted when made, but need to be aware of excess contributions. So I don't need to take the deduction, but that contribution space has been used. If I put, let's say my contribution space is $29,000 and I put in $30,000, that's an excess contribution. I've added $1,000 more than I was really allowed. The government allows for these small differences. They allow a $2,000 cushion. So they're not too concerned about that $1,000 extra. But let's say my contribution space was only 25,000. So when I add 30,000 to the account, I've over contributed 5,000. So that cumulative excess, that extra $5,000, I get a cushion of 2,000. So that 5,000 excess is now 3,000, and I will pay a penalty of 1% per month. The reason it's 1% per month is because getting above a 12% return is actually pretty difficult on the market. Some people do, some people make 15, 20, 30%, but most people, when they're investing, make 3 to 10% returns. So to have a penalty of 12%, it makes it very hard for that extra income in the RSP to really have any long-term benefit because the penalty is so extensive. So that extra so the 25,000 was my space, a $2,000 cushion, that $3,000 of excess contribution is charging me 30 bucks a month. So the cumulative excess is the undeducted contribution if it's greater than the sum of unused RRSP deduction room plus a $2,000 cushion. The penalty can be waived if it's a reasonable error and if I take steps to remove the excess as soon as possible. I say, oops, thought I had 30,000, turns out I only have 25. I immediately took back the $5,000. They say, okay, you've made a correction, we'll leave it. So if we were trying to plan our RSP contributions, if withdrawn within 1 year after penalty assessment, we can deduct under the Income Tax Act. So we have our excess income, but we gave too much. Well, as long as we take it back out within a year, we can avoid the penalty. Your tax when withdrawn, no deduction, but the real item comes into is that $2,000 penalty-free cushion means if someone wanted to maximize the outcome of their RSPs, they can contribute their contribution space plus $2,000. So if you're maintaining that $2,000 over threshold for 40 years, that can add up to a bit of money. The only thing is you're removing any cushion. You're much more likely to make a mistake. and accidentally contribute too much and immediately go into those excess penalties. So not most people don't use up that $2,000 cushion. They like to leave it. But if there was someone who is interested in maximizing their outcome and they keep track of every dollar, they can sort of ride that $2,000 cushion and over contribute it by a small amount. If I do not take my contribution deduction, I can hang on to it and deduct it in any future year as long as the sufficient deduction room is available. So I can only have enough deduction available for the amount that I contributed. Okay, let's go through. Now, let's go into the exercise. I want to do the calculations first. So unused RSP deduction room. Mr. Victor Hashlish has 2023 earned income for RSP purposes of 38,000. He's not a member of an RPP or a DPSP. His unused RSP deduction room carried forward from 2023 was $4,800. In 2024, he contributes $6,000 to his RSP and claims an RSP deduction of $4,500. So he only deducted $4,500, but he put in $6,000. So he's hanging on to $1,500 of deduction space. What is the amount of Mr. Hashless unused RSP deduction room and undeducted RSP contributions at the end of 2024? Instead of deducting only 4,500, let's say he wanted to deduct the maximum RSP amount, how much more would he have to contribute? So we have a person who makes $38,000. They don't have an RPP or DPSP, and they've contributed to their RSP. So the unused deduction space at the end of 2023, we are told is $4,800. This is left from a previous year. So it's our A, it's our starting point. To this number, we can add 18% of earned income. So at the end of 2023, we need to use his 2023 income, which we're told is $38,000, and we can contribute up to 18% of that. So that's 38,000 times 18% is 6,840. We can contribute 18% up to this limit. So I have this tab here, RSP limits, that details the limits for the last about 8 years. And you can see that this dollar limit goes up every year. In 2023, the money purchase limit for RPPs was 31,560. So when we go back to our calculation, 31,560. So the amount that we add to our deduction limit is the smaller of these two numbers. So our earned income calculation was well below the dollar limit. So that is what we will add to our 2024 deduction limit. 4,800 plus 6,840, 11,640. Sorry, we're using the 2024. So 31, whether we're using the RPP 2023 or 2024 dollar limits, the same number. So the RSP deduction, the amount that he's allowed to subtract from his income is the lowest of three numbers. His RSP deduction limit, which we calculated as 11,640, how much he actually contributed, $6,000, and how much he chose to deduct, 45. So he put $6,000 into his account. He's only deducting 4,500. So we have unused deduction space of 7,140. This is not the same as his unused contribution space because he used $6,000, but he only deducted 4,500. So you do kind of have to keep track of both these amounts because the penalties on over contributing is based on your contribution limit. How much you're allowed to deduct or your deduction space is based on how much you've actually subtracted from income. So 11,640, he deducted 4,500. He has undeducted contributions of 1,500, but let's say he wanted to maximize the deduction, he'll need to add another 5,640 to the account. He's put in 6,000, so he needs to add the difference to get up to this 11,640. So if he adds, so if he adds 5,640, Now his deduction is matching his contribution. And right now he's only chosen to deduct 4,500, but he wants to maximize it. So he chooses to deduct 640. So this equals the minimum of these three numbers. But we've now made it that those three numbers are the same. So we get to deduct our full amount. So to deduct the full amount, you need to contribute that amount, and then you need to choose to use all of it. So this is back to 4,500. This is back to 6,000. That are red so we know when we're subtracting something. Okay. Maximum RSP deduction. So now we want to maximize our deduction. In 2023, Mr. Black has employment income of 75,600, taxable capital gains of 23,650, rental income of 6,530, and pays spousal support of 18,000. So we are given the information to calculate his earned income. Based on RPP contributions of $2,400 and the matching contributions made by the employer reports a pension adjustment of $4,800. Mr. Black has unused RSP deduction room carried forward from 2023 of $10,750 and undeducted RSP contributions of $6,650. So he can contribute still $10,750 into an account, but he has undeducted amounts of $6,560. So he's put money in the past and hasn't subtracted from his income. In 2024, he makes further contributions to the RSP of $13,002. Determine Mr. Black's maximum RSP deduction for 2024. Let's assume he deducts the maximum, and we'll determine any unused RSP deduction room that will be still available at the end of 2024. So for 10-7, the first thing we need to do is calculate earned income. So this calculation's like we saw in exercise 2. The net employment income was 75,600, but we are told that there was an RPP deduction of 2,400. So we're going to add these back together to see the gross income of 78,000. Income and loss from a rental property, we had income of 6,530. And they paid spousal support of $18,000. So the earned income was 66,530. We were told there's also capital gains. Was it capital gains or interest? Taxable capital gains. So there was capital gains of 23,650, but we're not including that in earned income because it was passive in nature. So taking 66,530, our calculation says our contribution space is 11,975. We'll see this again when we move over. So we've figured out the earned income is 66,530. Our unused deduction space was 10,750. Because the pension, the RPP contribution from the employer was 24, and we matched the 24, our pension adjustment was 4,800. We've used up that much space. So 10,750 minus the pension adjustment plus the increase in our contribution space because of our income. 66,530 times 18%, rounding it off to the nearest dollar, is 11,975. That's what we have down here, 11,975. So combining these numbers together, 2024 has a deduction limit of 17,925. We're told that we have undeducted contributions of 6,560, and we made further contributions of 13,200. So we've added these amounts of money into our RSP, but we haven't taken the deduction yet. So our total deduction we can claim is 19,760, but we only have 17,925 of space available to us. We subtract the lower amount from our income. So our unused deduction space is 0. We've already used up all of our deductions from our income, but we contributed more than we had available. So we have an excess contribution, 19,760 minus our 17,925. We have an excess contribution of $1,835. Now, luckily, this is below $2,000. It's still within our cushion, so there's not going to be any penalties related to this. There's one more question I'd like to do. Still on excess contribution. So Miss Lucy Brownell is not a member of an RPP or a profit sharing plan. At the beginning of 2023, Miss Brownell has no unused RSP deduction room. In 2022 and 2023, she earned income of $170,000 each year. So her income's the same, and she's not a member of an RPP, so we have no deductions to worry about. On July 1st, 2023, she makes a $31,350 RRSP contribution. She does not claim a deduction. In 2024, she's earned income of $50,000, makes a $35,000 RSP contribution on May 1st, but still does not claim a deduction. Determine any penalty tax that will be charged to Ms. Brown for excess contributions in 2023 and 2024. At income levels of 170,000 times 18%, we have contribution space of 30,600 in both years. The 30,600 for 2023 and 2024 is below all of our contribution limits, so we don't need to worry about that. So in 2023, we contributed 31,350, but our deduction space was only 30,600. So we have an excess of 750. In 2024, we contributed another 35,000 to the account, but we only produced contribution space of 30,600. So we have an excess amount, 750 plus our deposit minus our additional space. We're over contributing 5,150. We have a cushion of $2,000, so our excess contribution subject to penalty is 3,150. So we subtract our contribution space, subtract our cushion. So our penalty is 1%, 1% of the excess amount for every month that's outstanding. So because we contributed in May, it was outstanding for 8 months, from May 1st to December 31st. So for 8 months, 1% of our excess amount comes to $252. So we'll have to pay a penalty of $252 for over contributing to the RSP account. Okay, I'm going to just finish up the next handful of slides, and then that will be good for this video. So I always talk about taking money out and getting taxed. Well, how do I take money out? There's a few things we can do. For one, it's the lump sum withdrawal. A lump sum withdrawal is I just go to my bank and I say, hey, give me $10,000 for my RSP. They'll take the money, they'll deduct taxes and give you the difference. So at 20% for $10,000, I will receive 8,000 of it, and the other 2,000 will go to the government for my taxes. Amounts withdrawn are included in net income, so I still add the full $10,000 to my income, subject to withholding tax by a trustee. So $10,000 is the income, $8,000 I received, $2,000 gets applied against my tax account. Unlike a TFSA, once withdrawn does not result in a reinstatement of contribution space. So every year we accumulate contribution space with earned income, but once we've added to the account, we've used that space. If we take money out, we don't get that contribution room back. Once the money's in, it's used up. It's not eligible for the pension income tax credit or pension income splitting. So that's on a lump sum withdrawal. Now I can, instead of taking just $10,000 or however much I want to withdraw, I can change it to an income stream. An income stream is I pretty much take the balance of my RSP and I say, give me, and it's called an annuity. So an annuity will pay out a certain amount of money every year. Usually It can be a life annuity, so it'll pay out that certain amount until I pass away, or a fixed term annuity saying, okay, we're going to pay out X number of dollars, say $38,000 every year for 20, 25 years. So these annuity amounts are going to pay every year. Um, and it will normally, under a regular annuity, the money I put into the annuity, the money I put into the annuity is capital. So when it pays back, it doesn't add to income. But our capital amount came from a retirement savings plan. So it was never taxed. So it's very straightforward that pretty much between a lump sum or an annuity payment, it's all included in income. If my 38,000 per year annuity gets paid out, I add 38,000 to my income. An advanced life deferred annuity is just like an annuity, but it starts at like 85, I think. Yeah, the initial payment's deferred until 85. When you make decisions about your annuity, you're probably around the age of 70. But in this day and age of extended health, some people can keep working. And so they might not want their pension annuity and their employment to add together and put them in a big tax bracket. So they say, well, I'm still working. So can we delay the annuity payments to start when I'm 85 or 80? I can defer until 85. But they all function roughly the same way. It's a fixed amount of income that will be paid to you each year, and all of it will be included in income. Variable payment life annuities they pay a fixed amount, but they also allow for other prices. So maybe a certain return or a consumer price index. So if if the account has a good year, maybe in a given year you get paid more, it's still all taxed by what you receive. Um, but income streams are generally available for pension income tax. When you pull a lump sum payment, you're kind of just taking an amount. I'm taking $10,000 because I need it. But if you have an income stream, I've set this up to be pension income so that it fills my taxes as if it's the same as employment. So you will get the pension income tax credit, and it's allowable that you might have pension income splitting. We will talk more about RIFs when we get later in the chapter, but a RIF is not quite an annuity in the sense that it's not paying out a certain amount. The RIF is um, the RIF is sort of saying what's a minimal amount to be withdrawn from your pension. So when you have an RSP, it's completely up to you how much you pull out, but as you get older, the likelihood that you should become deceased increases every year. And so when you pass away, all of the income in your pension account gets immediately recognized in income and can really jump people to a really high tax bracket. So you're forced at the age of 70 to convert to a RIF. And what it is a RIF is like an RSP, but it just denotes a minimal amount of withdrawal you have to take. The intention is to make sure that you're still pulling money, hopefully when your income is low. And so that should you pass away when you're, let's say, 90, you won't have a sudden large amount to set up to be still in your pension account to be taxed at a high rate. If you don't want to have a RIF, you have to either take the income, all of the money out of your RSP before that date, or you can convert your RSP into one of these annuities and you will function off of these rules instead of the RIF amount. But when an RSP gets transferred to the RIF, it rolls over, which means there's no income inclusion. It's just changing the account type from an RSP into a RIF account. It's called a retirement income fund. So unlike an RSP, you can't add money to a RIF through deposits. You don't get deductions from it. The RIF is mostly about we are now going to be paying out the pension account. If there's an involuntary termination due to age limit, so the RSP terminates when you turn 71. So you can convert to a RIF at any time. Most people don't. Most people, once they turn 71, they are forced to whatever the balance is on that time to convert it to a RIF. Now, contributions to a spousal RSP are still possible up to the year the spouse turns 71 years of age. So once my RSP becomes a RIF, I can't contribute it to it I can't contribute to it anymore, so I can no longer get the deductions. But if my spouse is still, 60, maybe they're a few years younger than me, 65, 66, I can still contribute to their RSP, continue to get those deductions. And then once they turn over 70 years of age, now we both have RIF accounts. Okay. That's it for the discussion of RSP details for now, contribution space. When we return, we will get into more details on the spousal RSP, and we'll start talking about withdrawals from your RSP that might not have immediate tax consequences, specifically the home buyers plan and the lifelong learning plan. For the time being, thank you for watching, and I'll see you in the next video.